Before I kind of want to get started with capital gains tax, I just want to throw a poll up here just for getting an understanding of why people may be thinking of selling some of their properties. I'm just going to launch this. So if you can vote ahead of why you may be thinking of selling properties. And the first one may be Section 24, obviously, because of the budget announcement changes. There could be some things going on. You could be looking at legislation and, the local authorities with the licensing laws and so on like that, all getting a bit much. Or return investment. So you could be thinking, well, actually, I know I can get better return investment. I've got some properties in London, but I know that I could sell those in order for me to buy a property in the north and get better return investment. Or the last one is want more money to invest elsewhere. You might have had enough of property, or you have decided, well, actually, I want to sell my residential properties to get holiday lets. And interestingly enough, I think 50% is whereby we've got Section 24. Obviously, a lot of people think about swapping their properties on and want to invest elsewhere. So interestingly enough, not much on legislation, not really being put off by legislation changes, so that's good to see. And return investment not good enough. There's none of you that thinks they could get more return investment elsewhere, which is a good thing. So let's just go through. Hopefully I can just see share results. I'm not sure if you guys can see this, so I will move on. But Section 24 and want to invest money elsewhere, probably from residential property investing, seems to be really the key ones here. So let's talk about capital gains tax and allowances and rates. It's good to start the foundation of tonight's webinar with some basic information. And we're going to do that process here. Now, I thought my cursor was going to work. It's not. So here's the CGT allowances. And what I've done here for you, I've put them year by year from 2014 all the way up to present day. And you'll notice that the capital gains tax allowances have indeed increased, but not significantly. HMRC haven't been terribly generous with their CGT annual allowances. And this is the amount of money of gain that you can have before you pay any capital gains tax. So currently it's 11,700. So if you had a property and you made a gain of 11,700, then you wouldn't need to pay any capital gains tax as a result. However, if you're a trustee or you want to put your assets into a trust, then you just need to bear in mind that the rates for trustees is a lot less than you as an individual, half in effect. So those are the rates. Now let's have a look at something that came into play by George Osborne before he left. Obviously, he introduced Section 24, remove wear and tear allowance, had the 3% surcharge on SDLT or stamp duty land tax. But one of his parting gestures was that he wanted a lot of people to sell their properties to give chance an opportunity for house buyers to own property instead of those dreaded landlords that we all are. But one thing he did do is he reduced capital gains tax to 10% for basic rate taxpayers and 20% for high rate taxpayers, but not for property residential investors. So we, and I see clearly including myself here, that own residential property investments in our own names, we would still be subject to 18% CGT and 28% as a high rate taxpayer, which is the old rates. So you could argue, has George Osborne yet again, in those changes that he made, targeted landlords to get more money off them? So he wanted to introduce Section 24 for people to sell properties and yet did not lift the lid on capital gains tax rates. He wanted to keep those at the highest level, clearly trying to penalise landlords like yourself and me, even though if he said he wants to do the right thing, then in my view he should have stripped out capital gains tax and allowed us to sell property without us being penalised and then putting properties back into circulation. That clearly wasn't going to be the case. So has it worked? Clearly not. That is the answer to that. But I do think that capital gains tax is an option. And I'm going to go through some of the things that just give you a bit of an idea of how capital gains tax really works. And I'm going to look at a basic example for you here. So this is a property that is 200,000 sales price, sold after 3 years, and it was a buy-to-let throughout the period. Now you might have sales fees. So sales fees could be estate agency fees, legal, solicitors, etc. And then your net proceeds out of that is 198,000. Now your purchase cost could have been back in the day, if you're lucky to have such a good deal that I'm showing on my page here. But if you purchase a property including SDLT for £100,000, and then you have some capitalised items. Now capitalised items here may be that you put in a new kitchen, you created an extension on the property, and those particular costs were not, please note, were not claimed in your self-assessment. You can't have some of the repair, replace, renew items that I talked about, whereby you may replace a bathroom, you may repair tiles, and you may repaint the property. All of those items for income tax purposes can be offset against your personal income in your self-assessment. However, you can't have your cake and eat it, as they say. So you can't have the costs allocated in your personal self-assessment tax return as well as having those same costs as a capitalized cost as well, because that would be double counting. So you must, when we talk about capitalized costs, they can't have been claimed already in your self-assessment. That's why the SA is there, self-assessment. So in this example, we've got a £78,000 taxable gain before any annual allowances have been taken into account. And let's have a look at what really that means. So since £78,000 with the new 11,700 CGT allowance in place means that there is now a taxable gain of £66,300. And if you're a high rate taxpayer, as I mentioned before, it's not 20%, it's 28% because this person holds a residential buy-to-let investment. And as a result, you will be paying a tax bill of £18,564. And I want to start really for this webinar to highlight the fact that I do say that certain taxes are indeed optional. CGT is optional, and I'm going to share with you some of the ideas and concepts that you could take away with you tonight, by the way, and make sure that you can become more tax efficient. IHT is also an optional tax if you do it correctly. Income tax, not so easy, I have to be honest, but there are certain income taxes, whether you move that into a company structure or not, to reduce the amount of running tax, I would say. SDLT, there are ways of minimizing that as well. So we're going to focus obviously tonight on capital gains tax, and I'm going to share with you why that 18,564 may be eradicated altogether. So as I mentioned, if you've got any questions, make sure that you do ask them away. Type ahead whilst I'm going through this content with you this evening so that I can really be answering those questions that you've got. Please don't leave this webinar with unanswered questions, because that's really a failed webinar for my purposes. This is not an education. This is meant to be more of a workshop, albeit I can't see you. But it would be good to get some feedback in terms of what you took on board, what's learning, what have you learned so far. But also, if you've got any concerns, doubts, or questions, feel free to type those in, and I will get back to you. So the first one I'm going to talk to you about is deed of trust. This is especially when you've got properties that's owned by two people. But you can do a deed of trust whereby it's owned by one person. What I'm going to share with you tonight is one example where I said that if you buy a property in just one person's name, you will get just one CGT annual allowance. However, there are ways of buying property whereby you both have a share of the property. So you can buy properties 50-50, which you all know is joint tenancy. Or you can have a 99% split one way and a 1% another, which is tenants in common. So just some of the legal wranglings around that. But I'm going to share with you tonight about deed of trust and how you can manipulate your particular tax schedule. And you could do a deed of trust as many times as possible. So people do get et up about, well, if I do a deed of trust once, does that mean that we have to fix the percentage shares as we see? Well, if you had a property that's 50-50 and you're a high rate taxpayer, for instance, for income tax purposes, you might say, well, is it better to have more of the property income for my basic rate tax paying spouse? And that absolutely would be a good tax planning mechanism whereby the high rate taxpayer would have 1% in the share and the basic rate taxpayer has 99%. You might both wish to have ownership because of mortgage purposes. But it is a very good way of really minimizing your income tax position. And it is part of my overall tax planning we have with our clients. But I'm focusing really on CGT because it does mean that, albeit you might have done a deed of trust once before, you can put different deeds in place to not manipulate harshly. That sounds like kind of tax avoidance or tax evasion. But deed of trust is a document that HMRC recognised, and they've talked to me about that with several of our clients. So you can use these documents for tax planning purposes. And just so that you can see what I'm talking about here, you may have a deed of trust, which is the more for legal documentation that you get from solicitors. We do these as well, bearing in mind. I'm going to share with you how we might be able to help you reduce your CGT bill. But then underneath that form, there's two forms on that screen. The second form is HMRC's Declaration of Beneficiary Interest in Joint Property and Income. And that's whereby you would fill in this document whereby you've got 50-50 share ownership and you wish to transfer that to be a different share. And as I mentioned before, that could be 99% to one person and 1% to the other. Typically, you would need to be husband and wife to do this transfer. If you was anything else, like a couple that aren't married, a father and son, or some other relationship, then I wouldn't put a deed of trust in place because you would have a capital gains tax to pay. And that would be based on market value, even if you transferred that property for zero proceeds from your loved one that you're transferring to. So do be careful with when you're trying to transfer assets between loved ones, unless it's your spouse, then you more likely to pay capital gains tax because of that transfer. So let's take an example here. Deed of trust, we got £50,000 earnings for Isabel, and we're going to follow Isabel later on actually in a couple of examples because there's some kind of a few things that I want to point out to you. And then we've got Tony here, who's self-employed, just starting out his self-employment business and is generating £10,000 worth of taxable profit. And you'll notice straight on the back there, I've on the third line here, I've put in 11,700 CGT annual allowances each. So each person can get 11,700. So it's really important for you to work out when you're buying property, you've got to think about the exit strategy as well. So if you're buying property just in one person's name, they will suffer the capital gains tax whilst just having one lot of the 11,700 CGT allowance. If you buy property and as a couple, then your CGT allowances will go up in by double. And I'm going to send by tomorrow. I will be sending tomorrow afternoon a spreadsheet that will help you understand your capital gains tax liabilities. So feel free to type that in. There is a video of how to use it as well, albeit a different format, I have to say. But make sure that you use that because it will help you understand what your CGT liability is going to be. So, as it says there, capital gains tax, there are no CGT implications by transferring between husband and wife or civil partners, but 100% CGT will be applicable for any assets that you transfer from outside of that husband-wife civil partner relationships. So again, please be careful of how you transfer assets between loved ones. If you are doing a deed of trust, especially, this is the case by the way, if you are a property is owned by one person and you wish to put, so in this case, Isabel has a property in her name alone, and she wishes to give 50% to her husband there. She could do a deed of trust, though husband and wife, so there's no capital gains tax. But what you do need to think about now is your mortgages. If Isabel says, well, okay, Tony, come on, let's share the property, they may have to as well, because the mortgage covenants share the element of the mortgage as well. So SDLT, as we all know now, there's a 3% surcharge. So there could be an SDLT surcharge to take into account if it's seen that Tony has taken more than £40,000 of that mortgage. So you could be triggering an SDLT charge by using these deed of trust. So again, some tax planning needs to come to a force here to make sure that you speak to the banks. You're being open and transparent for the terms and conditions, but you're saying to them, look, I don't want my spouse to take or assume responsibility for the mortgage. The assume responsibility is key words in terms of the legal matter here for SDLT purposes. So if Tony does not assume any mortgage, does not take responsibility at all, and it remains with Isabel, then the SDLT considerations will not take effect. So you won't have to pay SDLT. So that is something you do need to bear in mind if you've got a property in just one person's name and you want to transfer it to another. You will need to do some more documentation. We don't get involved in that side of things. I have to say that's more of a solicitor's thing. But it is something that I want you to bear in mind. So in the previous example, what I was trying to do is show you that you had a £78,000 taxable gain, and you remember that they had a gain tax as well. But if you manipulate the percentage share, and we have this with several of our clients, even if it's 50-50, it could be as quirky as something like, Tony, we give you 65% share, and Isabel keeps 35% share. Our spreadsheet calculating tool tells you the specific amount of percentage that the share ownership gives you for a tax efficiency purposes. So make sure you're using this spreadsheet to really minimize the tax liability of selling properties. So just going into this example here, we've got £78,000 taxable gain as we did in the previous example, but now we've got two lots of CGT allowances, so 23,400 taxable gain, but we've manipulated the system so we're utilizing Tony's basic rate tax band as much as possible here, and then they've both got a share of being a high rate taxpayer as well. Isabel, please bear in mind, is always a high rate taxpayer, so she will always pay that 28% tax. So then the tax bill is now reduced down to £11,653 by just some careful tax planning. We've saved £5,000 pretty much for this relationship and selling this particular property. Now you're probably listening to me saying, well, hold on, before you said we can minimize CGT altogether, if not eradicate it. Well, that's true, but please do keep with me on this example. Okay, so here's some, you see that? I took my drink a little bit early there. So let's go to some Q&A. Let's have a look at if there's any questions arising, and I will do my damnedest to help you answer those. So question from Gillian. So because we are residential landlords, are we subject to 18% or 28%? Well, the 18% is for basic rate taxpayers. The 10% is the new rate for basic rate taxpayers, but not for you residential property landlords. The 28% is for those that are 28%, the 28% is for the high rate taxpayers, which is reduced to 20% if you are not a residential property landlord. Okay. So next question was, can you do a deed of trust anytime before selling the property? Yes, that's a great tax planning tool. One of the things I had was a conversation I had with HMRC probably about, I'm going to guess, I think it must have been about 2 years ago. And I was talking about deed of trust, and I said, look, in this situation, one of the parties in this marriage, they was managing the properties and they wanted the share of the income. They're going to spend the money for themselves basically for having this property, and they was managing it. And the other half was kind of career-minded, really wasn't into property, but was happy to go on a mortgage just to get these deals for the other party. And but I spoke to HMRC and said, well, this is great for them, but when it comes to selling the property, you want to utilise their CGT annual allowances. Can we do a deed of trust anytime? And they said, yes, absolutely. You could do another deed of trust almost one day before you sell the property on. So you're saying, well, it's, we take it for 50-50. We're moving it 99% to the basic rate taxpayer, 1% to the high rate taxpayer. But a couple of days or a week before you sell the property, you say, well, actually, what percentage does it need to be more tax efficient? And it could be 70% still to the basic rate taxpayer and 30% to the high rate taxpayer, just to utilise their CGT annual allowance. So you can do deed of trust as many times as you want. That's come from HMRC themselves. Talk about tax planning, that is really, really good. Okay, so someone's just asked a question. What about gifting? Is this only for IHT? I'm not going to go into the depths of gifting properties and using IHT tax band. You can do that, and you can look at our article on that. That's a lot more advanced tax planning than I can really go into tonight. So what I'm going to be talking about tonight is how you minimize capital gains tax rather than gifting through trust, which is a very complex conversation to be had, to be fair. So there was another question just being fired at me, actually. I just couldn't see it. How does this to limited company owning the property, can deed of trust be given to children, but still control rental income until they become of age? No. If you're trying to get the deed of trust so it goes to the children, but really you're still benefiting from that. A couple of things for you on that. First of all, you will have to pay capital gains tax if you transfer any assets to your children immediately, even if you carry on having the legal title, but the beneficiary interest goes to your child. Now, that's completely waste time, and I'll tell you the reason why. Because if your child is a minor under the age of what's considered 18, or a dependent, I should say, because it could be in full-time education, it could be older, then any income that's generated by that property in their names, as in children's name, will still be deemed to be your income. So you've just paid capital gains tax, transfer it to the child, and yet HMRC will look at this arrangement and say, no, it's close proximity, we don't like it, so we're going to treat that income as though it's yours. So sadly, I wouldn't go down the route of trying to transfer anything to children. So I can just say that's done. Hopefully that worked. Perfect. Okay, so let's move on. So capital gains tax we haven't eliminated just yet, but you can move into the property. Now, this is not going to serve everyone, I appreciate, but I'm going to give you some scenarios whereby hopefully one of my ideas may be utilised by a couple of you. So moving back into a property is the next subject. And again, I'm going to carry on the same theme as we did before, whereby you've got this situation going on, whereby you've got £78,000 worth of taxable gain. You've got the 2 lots of CGT annual allowances now for the couple instead of the $11,700 for just one person. You've now still got the taxable gain of $54,600, but now you've got the split, as we've shown before, giving you a total capital gains tax bill of $11,653. So how do we get around that? Well, if you moved into the property, there are some allowances that I think you should be aware of. The first one is private residency relief. So if you moved into a property and you lived in it and it was your main and sole home, then you can get relief on any gain that you make. And as it says there, you will get relief for any time or in period that you have lived in the property. But the last 18 months that you own the home, even if you weren't living there, would be part of the private residency relief. It means it helps you reduce your capital gains tax. So if you've got a good, nice house, and you think, well, actually, if I sold this, I would end up paying lots of capital gains tax. Why don't we move into that property, let's just enjoy it for a few years and then think about selling it on. You have to legitimately move in. You can't just say, well, hey, that's my private residency relief. You can't have two private residency reliefs. As in, you can't have one home and then have this other buy-to-let now as your secondary private residency relief. It does not work. You can only have one property as your primary residency relief. But it does mean that you could live in that property for a year, 2 years, 3 years, however you kind of want to, and you could benefit from this relief. In addition, because as we shown earlier, this couple has purchased the property as a buy-to-let property, but they've moved into the property. But it does also mean, well, not only can they get the private residency relief, but they can also claim the letting relief as well. So there's two reliefs that we need to take into account. There's a private residency relief, and there's also the private residency relief equivalent of lettings relief. And you'll notice that the letting relief is the lower of the PRR, as I've just described, £40,000, or the taxable gain made. So you do get two lots of allowances. I'm going to share with you not the specific calculation, because that's what calculation tools are there for. They do the hard work. What you're using these tools for is scenario planning. So let's just go into this one. So this is your deed of trust, and as I mentioned before, you've got your £200,000 property, but this time, instead of kind of the 3 years, we're going to sell it after 4 years. Now, it was buy-to-let, but we've moved into the property now for one of those years. Okay, we still have this £2,000 sales fees, and now we've got the £198,000 net proceeds from the solicitor, but obviously you've got mortgage and whatever else. But for CGT purposes, you've got the purchase cost plus the SDLT and the capital cost that we had before. So you still got the £78,000 taxable gain. There's no difference. And you're thinking, well, what's the point of this slide or at all? And it's really for this reason. You see, £78,000 was the taxable gain that we had before, but now we've got PRR, which is last 18 months worth, which is equivalent to £29,250 in this example. We've also got lettings relief, which is equivalent, because PRR is less than £40,000 and it's less than the total taxable gain. So the lettings relief is tapered down to the level of PRR, which is £29,250. And now you've got a taxable gain of £19,500. But don't forget, we already said, because we're getting a couple to buy the property, not the individual. Now they've got CGT annual allowance for a couple rate of £23,400, and ergo, zero capital gains tax. And I've mentioned this before, capital gains tax, just like any other tax, can be optional. You don't have to pay it. With careful tax planning, you can get away with selling properties and pay no tax just by doing a few tweaks here and there, and your scenario of paying tax is eradicated forever.